Hello, everyone, and thanks for joining our webinar today. My name is Erin Campbell, and I am the Regulatory Research Services Manager at the NAIC's Center for Insurance Policy and Research. And on behalf of CIPR and the Institute's Griffith Foundation, welcome to this installment of our Back to Basics webinar series. The goal of this series is to delve into the fundamentals of key issues within the insurance ecosystem to better inform public policy conversations. Previous webinars in our series have covered insurance pricing, captives, fraud, reinsurance, surplus lines, and climate resilience. Today, we continue on with the second part of our series on guarantee associations. In part one, we explored the life and health side of the house, and recordings of that first session and all previous Back to Basics webinars are available in our NAIC library catalog. In this session today, we will focus on P&C guarantee funds, which I think is fitting for Halloween because what's spookier than an insolvency? Today, we will cover the history and origins of the guarantee system, funding mechanisms, and the liquidation process. Additionally, we will discuss the crucial role of guarantee funds in consumer protection and the solvency regulation infrastructure, as well as the different roles played by regulators and the guarantee funds themselves. Our expert speakers for today are Dr. Evan Eastman from Florida State University, Laura Lyons-Slaymaker, Pennsylvania Insurance Department, and Roger Schmelzer, National Conference of Insurance Guarantee Funds. Our Q&A segment today is moderated by Frank Tomasello of the Institute's Griffith Foundation. I will place a link in the chat shortly, and that will include materials for today, including slides, bios for all of our speakers, CE certificate information, and a link to all the previous Back to Basics webinars. We are recording the webinar, and the recording will be available in the next few days at this same link, as well as on the Griffith website. We'll be using the Q&A function for questions, and we'll try to get to as many as possible. So please feel free to drop your questions there throughout the program. At the end of our session today, you'll be prompted to fill out a very brief survey, and we'd appreciate your feedback on this webinar as we plan for events in the future. And now I'll hand things over to Dr. Evan Eastman to kick things off.
All right. Thank you. Thank you, Erin. I should have shared my screen now, so hopefully this is working as intended. So thank you to the organizers, and thank you to everyone who's here. Happy to be here talking about P&C guarantee funds, and I think this is an interesting topic. So let's get started. So my goal here is to provide a big picture overview, and I know that we have folks from a lot of different backgrounds, so I'm going to start very zoomed out, maybe as zoomed out as possible, just to make sure we're all on the same page. So what we're talking about here today is the property casualty insurance industry, sometimes called the property liability insurance industry, which is one segment of the broader financial services industry globally and in the US, though here we're focused on the US. And what this segment primarily sells are property coverages for things that individuals or businesses own, and liability coverage for the potential exposure that we face for damaging someone else's property or someone else's person. Another way to divvy up this industry would be within personal lines, so things that individuals buy insurance on, which you can think of in your own life, maybe as if you own a home, your homeowner's coverage, or your personal auto policy if you drive a car. And then also the commercial side, which is going to be corporations purchasing coverage for their own property or liability exposures. To give you a sense of magnitude, this represents about $857 billion in premiums written. And these institutions are quite large, with their balance sheets holding $2.68 trillion in assets. What lines of business are we talking about here? The biggest area based on premiums written in 2023 is going to be private auto and then homeowners. So we're focusing there on the personal lines. And then we end up with some other lines of business. The line is called other liability. It's sort of a grab bag for everything else. But then you see some other lines like fire and allied lines and commercial, just to give you a sense of magnitude. So within this segment of the industry, and to move more towards these guarantee associations that we're talking about, historically and theoretically, as an academic thinking about this, how an economist might, what is the motivation for monitoring or for having a regulatory apparatus that looks over whether insurance companies are financially stable? One of the big arguments has been that there's an information asymmetry between insurers who are providing these policies that are essentially promises and customers who are demanding some sort of protection for some risk exposure that they face. And this information asymmetry exists, to jump down to the third point there, because insurance companies are complex organizations, arguably some of the most complex organizations in our economy. And it's difficult for individuals in particular to ensure that insurers are going to be able to enforce their promise or make good on their promise should we have a claim. And in addition, we're entering into long-term contractual agreements where an insurer promises to pay you a cash flow in the form of a claim payment should a covered claim event happen. And what we want to ensure societally is that companies will make good on this promise. And so we have this state-based regulatory system that has developed historically, and we don't have time to get into all the historical developments here today, but we do have this state-based system that will watch over companies using various forms of regulation to make sure that they make good on their promise to pay out claims to consumers. That said, despite regulators' best efforts, sometimes insurance companies, because of the nature of the business, do end up going insolvent or essentially find themselves in a position where they will be unable to make the claims payments that they promised to make. And so the question that we're answering here today, that the other panelists and myself will tell you about, is what do we do if, despite our best efforts, we don't prevent an insolvency? And why do we care so much about this? Well, this has societal costs, right? There's the foregone claims payments that you think you're going to get, say if your house is damaged and the insurer can't make good. This can also add uncertainty and delays in ultimately getting the claim payment. Not to mention that you may have to find a replacement policy, and depending on your risk exposure, this could be prohibitively difficult. I can say living in Florida, it's not always the easiest thing to get a different insurance coverage if you need to do so. And so the historical context that this came up in is what used to happen back before we had a guarantee fund system is policyholders for insurers would basically get thrown into a bucket with the rest of the claimants on the firm's assets, right? So you would just go into a court proceeding like everyone else, whether it's companies that are individuals or banks that lent money to the company or the owners, the equity owners, and the policyholders would be put in there and they would go through this very long and potentially uncertain process about whether they would receive any remuneration for what was owed to them through the claims process. We realized this was maybe not optimal. I say we to mean regulators and legislatures, and they decided to remedy this situation by creating a system that became known as this guarantee system, by creating a series of state-based guarantee funds starting in the 1960s, because these are state-based. These would happen or be enacted at different times in different states. And what these are in general are nonprofit entities created by individual state governments. And the job of the guarantee fund is that they will bear responsibility for the liabilities or the unpaid claims of insurers that become insolvent. And then insurers that write business within the given state become members of this guarantee fund system. There are differences across states because states can do what they want when it comes to insurance regulation, more or less. There is some degree of synchronization by these NAIC model laws that are essentially created as a sort of template or base that states can then use and legislatures can tweak or modify accordingly, or they can pass it as is. And so to the degree we do see similarities across states, some of that can be attributed to this system. As far as the details of how this indemnification works, I'll provide some generalities. I think both my fellow panelists can provide additional and can and will provide additional information there, though we're also happy to entertain questions if you do have particular ones. But in general, these guarantee associations will end up indemnifying policyholders up to certain caps. And the caps will differ by state and by line of business. Typically, they end up being around 300 to 500,000, though in some states they're higher. And one exception to this that I learned recently is workers' compensation, where we end up not seeing a cap. So in many cases, we can make policyholders whole again, though not universally, depending again on the line of business. Now you may wonder, where does the funding or where does the capital for this come from? Two primary sources. And the source number one is going to be recoveries from the assets of the insolvent company. And this is going to, in most cases, be the main source of funding. So when regulators take over a company that's heading towards insolvency, they can take the assets of that company, liquidate them as required, and then use this to pay the claims out of the guarantee fund. In instances where this isn't sufficient, what ends up happening is the guarantee fund will call in assessments of the surviving companies within the state where the insolvent company was. These tend to not be all that onerous. As I said, this is a sort of a secondary funding mechanism, and in many cases there are caps on these so that this is not putting stress on the balance sheet of the surviving companies who are not in an insolvent situation, since we wouldn't want to have any sort of cascade or put undue stress on those other companies. To give you a sense of how historically this has all looked, here's a report from AM Best looking at historical financially impaired companies from 1969 to 2009. And so this historically has been something that has come up, right? It's not it's not happening all the time that companies go insolvent, but it happens enough that it's important that we have these mechanisms in place as governments and as regulators to indemnify these policyholders should we end up in a situation where companies do go insolvent. And to give another way of cutting this, that brings us up to 2022. Again, from AM Best, if we were to break this down by line of business, we can see historically where this has ended up hitting most often. And as I alluded to earlier, workers' compensation, something where, though in recent years we haven't seen this as much, historically, this has been one of the more prominent areas where insurers go insolvent, necessitating some protections there for these potentially vulnerable policyholders. Similarly, in personal lines, once again, thinking about things like auto insurance or homeowners, where over the past few years, again, being local in Florida, we've had several companies writing mostly personal lines, writing mostly homeowners insurance that have ended up going through this type of proceeding, potentially due to either the liability environment in the state or catastrophes, either of which can have historically been sources of potential insolvency, leading to the need for a guarantee fund to take over for the policyholders. So with that, I hopefully got everyone up to speed and have provided a starting point, a jumping off point for this conversation. And so from there, I can stop sharing my screen and hand it over to continue this discussion.
Thank you, Dr. Eastman. We appreciate it. Great foundational sort of discussion for us on the origin, the underpinnings of the guarantee system. In just a moment, I'd like to turn things over to our next presenter, but first a quick reminder to our audience. We will devote the final 10 minutes of our session to Q&A. You may submit questions, as Dr. Eastman had mentioned just a few moments ago, in the Q&A box, and we will address as many as time permits. With that, join me now in welcoming to our microphones Deputy Insurance Commissioner Laura Slaymaker of the Pennsylvania Department of Insurance. She'll share her perspective on the P&C guarantee system through the regulatory lens. Deputy Commissioner, the floor is yours.
Thank you. Well, first of all, I think the guarantee funds are terrific. So I'll start by saying that. But if you could switch to the next slide, the mission nationally at the NAIC level is obviously to protect policyholders, claimants, beneficiaries. Absolutely, that's our first priority. Secondly, I have the mission of my office, the Bureau of Liquidation and Rehabilitation Administration in Pennsylvania, and that's also to protect the state claimants. And what we want to do is maximize the assets and then distribute them in a fair, efficient, and cost-effective manner. So we gather as much money as we can, and then we send it on largely to the guarantee funds and sometimes to individual claimants. Okay, next slide. Okay, so first, the petition for liquidation is filed. And that's actually filed by the other side of the Pennsylvania Insurance Department, and not really my office. And I'll say this because it's Halloween. It's like the living side of the company, turning it over to the dead side, which is my office. So once we get the liquidation order from the Commonwealth Court and a finding of insolvency, the guarantee funds are triggered, and my side of the office is triggered. One of the things we do is takeover, and I'll be talking a lot about the takeover because that's where I have the best stories. But one thing you have to do that you might not think of is, like, you have to go to the bank with a liquidation order and say, switch over the account so that, you know, the liquidator is in charge and no longer the company. That can be kind of stressful. And one other thing that we do is we hire professionals where appropriate. So sometimes there'll be a special deputy that's hired if the company is big enough and it's a big enough issues that are being discussed or relate to that company. Sometimes we hire a chief liquidation officer, and that person would run the day-to-day operations of the company. And sometimes the companies are just so small that we don't have either of those individuals, and my office just sort of handles the smaller company and administers it. I'll give you an example of one thing. I went to a small company. This was maybe 12 years ago, and I, went in and said, "Hello, I'm here to take over the company." And we heard this like buzzing noise kind of down the hall. So I sort of meekly went down and was like, "Excuse me." They were shredding documents in the office. So yeah, it can be kind of stressful taking over a company. Next slide. So that's the takeover process. We begin with a petition filed by the insurance commissioner and approved by the court, and we travel to the headquarters, and procedures are put in place to provide the control and oversight, because the board of directors cease control and the officers and employees then report to the liquidation team. So another important takeover tip is to secure the computer systems, because you don't want to give anyone the opportunity for mischief, because often these people can be angry. I mean, they're essentially going to lose their jobs down the line. And it's understandable. And at one company, some employees stayed on for a while because we needed them to get set up to administer the company. But once we got our arms around the estate, I had to sort of let people go. Every week I'd be letting different people go. There were tears, yelling. It was awful. I mean, I haven't had to do that in a while, and I'm very glad. Next slide. So the claims process is basically the form you fill out to get your claim paid. And that's generally cents on the dollar. Although, as I said, we do our best to collect as much money as possible to pay as much to the guarantee funds and the other claimants. So we coordinate mailing out the forms. And I know at this day and age, you'd think you could just go online and fill out a form, but not everybody has access to a computer, depending on what kind of insurance you're talking about and the sophistication of the claimant. So we really primarily mail out the proof of claim forms and the notices. We gather open claim files from the company and we send them to the Guarantee Association. Again, I'll be talking about this a bit later, but it's really data driven these days. We work with the IT staff to create uniform data standards. The UDS is the mechanism by which information is passed back and forth to the guarantee funds from the liquidator, and it works very well. Okay, next slide. Okay, assets. So I was saying we try to collect as much money as possible or marshal the assets in the estate so that we can pay them out to the claimants, including the guarantee funds. Most times they get cents on the dollar, but we work hard to get as much as possible. The court gives us broad power over the control and collection of assets. And we go through the process of retitling ownership, like the bank accounts, as I was saying. And we convert assets, liquid and non-liquid, to cash for distribution. We've had some interesting assets over the years. Like one would be a golf course on Amelia Island, which I think is in Florida. That was owned by the insurance company that went into liquidation, so we had to sell it. There's often cars, like there'll be cars that are part of the insurance company's assets, so we'll sell those. Houses and mortgages on real estate. I guess that's not so unusual, but that happens from time to time. A campground one time. Fishing rights in Colorado to a certain stream, I think. This was before my time with the fishing rights, but that's what I'm told. Antique maps, that wasn't that long ago. And this insurance company had all these antique maps, which we were able to sell and get a good price for the estate. And then there was a lot of artwork at one, and it was really neat. It was a Center City, Philadelphia company. So there were all these Philadelphia scenes. But we tried to sell the artwork, and nobody wanted it, and they were going to get rid of it. So it's actually in my office now. If anybody comes to Harrisburg and wants to see it, we have a lot of nice Philadelphia scenes. Okay, next slide. Next, we distribute the assets, and we have to file with the court our petition seeking to distribute the assets. If nobody objects, which they don't usually because they want to get paid, the assets are distributed. In Pennsylvania, the documents are given to the comptroller. We don't actually handle the money or the checks. It gets distributed out from the comptroller. Sometimes we can use ACH payments, like for the guarantee funds, for example. They're sophisticated enough that we can do that. But often we still use paper checks. Next slide. You heard talk about the NAIC model. That's the model for receivership is called IRMA, the Insurance Receivership Model Act. And states adopt some or all of it. It's great if you can adopt all of it. We have not in Pennsylvania. So next slide. We have Article 5, which is our governing statute, and it gives us broad powers, which is great. Its powers include, like, we can staff up and down as needed. If we were to get a big receivership in, we can staff up our office to be able to handle it, or we can shrink as needed. And of course, as I mentioned before, we can hire professionals like a chief liquidation officer to run the day-to-day, or a special deputy liquidator, or any other number of professionals like lawyers that we would need. Next slide. I felt compelled to mention the workers' comp situation because in my office, the Workers' Compensation Security Fund is actually run out of my office as one of the special funds. But it's really important to coordinate with the guarantee funds in this instance because people need to receive those payments, and we have to be coordinated so that when the company goes into liquidation, the guarantee fund can immediately take over so that there's no gap in payments. And medications, we have to make sure they're able to get their medications in the liquidation. And again, we work very closely with the guarantee funds to do that. I found out something interesting today as I was preparing. Our Workers' Comp Security Fund, the Guarantee Fund for Workers' Comp in Pennsylvania, uses paper checks if at all possible, although I think that's going to change due to some recent legislation that passed. And that's because if someone dies and there's a paper check, we know about it. We hear about it. If we're using ACH payments, sometimes payments will still be made months in, and then we have to try to collect the funds, which is no fun. So yeah, we use paper checks wherever possible. Okay, next slide. So the liquidator, I was talking about the takeover process. Part of the takeover process is data transfer, and this is really important to deal with the guarantee funds. We're in charge of all the records when we take over. So we used to have this liquidations van that we only got rid of maybe a year or two ago that would drive out to the liquidated company and fill it up. We'd fill it up with files, with claims files that would then be mailed to the guarantee funds, or sometimes they would be mailed on site from to the guarantee funds, and they would have all this paper. And I've been to estates that are very small where all the records are paper. I would say this was maybe six or 7 years ago was the last time that happened, where all the records were paper. Because now, everything's online. And so it's really important that the data can be shared and accessed and read by the liquidator, and also importantly by the guarantee funds. So we use coordination and advanced planning, which is crucial to effectuate data transfer. And that's all I've got. to the next slide, I guess, and then I will be finished. Thank you.
Thank you, Deputy Commissioner. Look forward to welcoming you and Dr. Eastman back here for the final portion of the webinar. But for now, let's turn to Mr. Roger Schmelzer, President and CEO of the National Conference of Insurance Guarantee Funds. He's here to share his thoughts on the important consumer protections that the P&C guarantee system provides. Roger, pleasure to have you here with us. We welcome your insight and expertise.
Thank you very much, Frank. And it is a pleasure to be on this program with Dr. Eastman and Laura, yourself and Aaron. I'm very grateful for the endorsement of the Guarantee Fund system from Laura. She's been one of the great champions of our system and our overall insurance resolution mechanism, which is unlike anything else in the entire world, and that's not hyperbole. It's a unique system that we all work very hard to maintain and improve on a consistent basis. So let me return the compliment with the first slide, if I could, please. Insurance regulators do good work. I would say they do better than good work. They do great work. Insolvencies are rare. There have been fewer than 700 over the course of the last 50 years. And as you can see, since the advent of risk-based capital in the early 2000s, the number has just declined year after year after year. The tools that were put in place in the early 2000s, late 90s and early 2000s have worked. And we have all seen the benefit of that in many, many different ways. But there still needs to be a guarantee fund system. And there needs to be a coordinating organization for it, and that is the job that NCIGF has. So let me tell you a little bit more about us and the overall system. Next slide, please. So NCIGF serves an autonomous state-based system. Dr. Eastman spoke of this. This is state statutorily based. Every state has a statute that creates a guarantee fund. Those statutes are updated almost annually, just as new ideas, new public policy ideas and technologies come online. Our organization has three primary strategic objectives. That is to support our members in terms of readiness, operations, and insolvency support. We provide education, outreach to all audiences, external stakeholders, such as what we're doing here today, and engagement with our members. Our membership is strong. We have, as you see on the next column, 55 guarantee associations. And it's very important for us to have all of our members engaged in what this organization does, because they are autonomous. They have accountabilities to their boards, to their state regulators, and this is a total group effort. The last item that we have as a strategic objective is public policy management. A state-based system, a lot of public policy out there that forms this system and keeps it operating. Sometimes the ideas for it are benign and good, and sometimes they're not so benign and not so good. So somebody has to stay on top of all of those things, and that's what we do for our members. In those blue letters there at the bottom of that red box, I referred to the Dodd-Frank Amendment, 2010, passed by the federal government, and the NAIC's Receiver Handbook. These are what I believe to be the formative and foundational documents of what NCIGF and the Guarantee Fund system does. The Dodd-Frank Act actually carves our entire resolution mechanism into federal law. It's the only mention of insurance in the Dodd-Frank Act. You probably didn't know that, but it is, and it does say that the state guarantee fund system and state receivership system will resolve failures of any size, whether they be small or systemically important. So we absolutely have to be able to act successfully on those rare occasions when we have to swing into action for a new insolvency. There are things that guarantee funds do every single day. that don't necessarily have to do with a new insolvency. But there's lots of work that goes on in these small businesses that exist around the country. So every state has a guarantee association. Some states have more than one. So that means 55 guarantee associations. 30 of those guarantee associations share cost, either with other claims paying organizations in their states, or potentially the Life and Health Guarantee Association in their state. I point that out because, yes, there is an administrative cost to having a guarantee association in your state and working on an insolvency, but we do everything that we can, our members, that is, to keep those costs reasonable so that we can perform the mission of the Guarantee Association. There's only about 600 employees around the country, and the whole system costs about $100 million, and that supports an industry worth $850 billion. Over 50 years, our members have paid out $35 billion with an assessment capacity of $164 billion. But again, to relate myself to Dr. Eastman's remarks, only $12 billion has been used over the years to actually of that assessment capacity. So again, the bulk of the capitalization of the system comes from the assets of the estate, and reinsurance is usually, almost always, the largest asset that is in that estate. In Indianapolis, where our office is, we have 17 employees. Our budget's about $5.2 million. Next slide, please. So we have goals for readiness and liquidation, and some of them you'll see correspond with things that Laura brought up. A near seamless safety net for consumers. I can't promise 100% seamlessness, but that's certainly what we strive for. Protecting the insurance promise itself. This is a system that is primarily, the money for it is fronted by the insurance industry, in addition to the money that comes in through the assets of the estate. And it's very important to insurance and to the industry itself that this promise be kept, and that the insurance industry be seen as credible to protect people. We strengthen state insurance regulation through this system. I don't think that can be denied in any way. It is very important that the guarantee fund system and the resolution mechanism entirely provides everything that makes state insurance regulation work when called upon. And lastly, we have an aspirational goal, and that is to reduce the cost of insolvencies. I can't give you any research on that just yet, but I know that that is what we want to do, and will continue to work on that. And this is important. All the readiness that we talk about is important because of the consumer protections that we do provide. Workers' compensation and pharmacy benefits, those are to be uninterrupted. And oftentimes the call will go out very early from a claimant saying, where is my check? And it's our job, our members' job, to actually get that check in their hands. Replacement homeowners coverage, unearned premium is very critical to consumers, so that if a company were to fail and the portion of their premium that won't be put to use can be refunded to them through the guarantee fund system, so that they can buy new insurance coverage. Automobile coverage is also extremely important, because there are vehicles that are needed for work-related or personal needs. Sometimes it has happened that an automobile needed for those purposes might still be in the shop being repaired when a company fails. And so it's very important to be able to help that consumer be able to get that car out as soon as possible. And cyber readiness is a new area that we're paying a lot of attention to. Regulators are too. The insurance company is the firehouse. The Guarantee Association is the firehouse. And these are not issues that involve price and money. They're more service-related issues. So those are key consumer protections that the Guarantee Fund system provides. Next slide, please. We feel so strongly about readiness that we have recently created a new strategic plan. We call it NCIGF 2025 Plus. It modifies the strategic objectives I mentioned a slide or two ago. And this is our strategy statement. NCIGF will proactively, on behalf of our members, drive changes necessary to meet future challenges for insurance consumers. We are the trusted expert on the impact of insurer insolvency on 3 key stakeholder groups: state guarantee associations, our members, the industry, the insurance industry itself, and state insurance regulation. Next slide, please. So why does this matter so much? Well, the pressures on insurers and consumers are very intense right now. We see it all the time: natural catastrophes, availability of reinsurance, generally the economic conditions, including inflation. And I break that out because there's also social and economic inflation. The explosion of litigation puts pressure on the industry, and public policy itself is something that has to be watched very closely. This creates what we call a readiness risk for the guarantee associations. These are dislocations to the market that have a downstream effect on the state guarantee funds. The potential impact we see are the expectations of the system to perform and how the statutory obligations of a guarantee association are met. I should clarify at this point that NCIGF, the organization that I manage, we do not pay claims. We are not in the same situation as a state guarantee fund. We support them, however, in their ability to meet their statutory obligations. Next slide, please. The profile of modern insolvency is, again, it's infrequent. The regulatory detection tools do work, but when it does occur, it's often due to uncontrollable events. And those uncontrollable events do not necessarily predict an insolvency, but that's certainly when we see it the most. Next slide, please. And this is what Laura spoke of at the end of her presentation: claims data, digital claims data, which is in every company now, it is in formats that may or may not be usable. So I'll just direct you to the gray box on the right-hand side. The guarantee funds are interested in receiving timely and usable data because it's essential for post-liquidation claim payments to commence, but it requires planning. Next slide, please. And so what the guarantee funds have suggested, and many regulators and receivers are supportive of, is a confidential exchange of fundamental information between regulators, receivers, and guarantee funds that occurs well before the liquidation order is signed. This would give regulators valuable insight into data transition readiness and complex product lines. And receivers will have usable data sooner to track reinsurance recoveries and process proofs of claims. Next slide, please. So I talk about the communications format, and this is called UDS. I cannot get more technical on UDS myself, but I want you to know what we mean when we're talking about. This is a specialized NAIC communications protocol developed for guarantee funds with NCIGF. Guarantee funds and receivers need this to read and process claims. It is not an industry standard, however, but it's approved by the regulators. So data must be converted for receivers and guarantee funds to meet their statutory obligations, and this can be tricky to do. NCIGF has developed and maintains a couple of utilities, technical utilities that support software for UDS. That's all I'll say about it right now. We could talk about it more in a whole different seminar if you wanted to do that. Next slide, please. So what we talk about is as far as a seamless transition, and we believe that this is made available in the new Receiver's Handbook, a seamless transition of 75 to 100 days of a runway for guarantee associations to be able to review the data that exists, determine where it is and what condition it is, and then follow these 4 steps to be able to transfer that data so that it can be used to pay claims quickly. Promptly is the statutory standard, I believe, in every state. Next slide, please. So the value proposition of early guarantee fund involvement, I think I mentioned this before. If I were a state regulator and I was being presented with a potential liquidation plan and needed to sign an order of liquidation, what I would want to know would be, when can consumers be paid? And if you don't factor in the 75 to 100 days roughly that the property and casualty industry, and it's different for the life and health, by the way, but if you don't factor in the 75 to 100 days, if you're not thinking about that in making the decision, the answer then to the regulator is, I don't know when consumers will be paid. And that would be seen, if it's extra delayed, that would be seen as a failure of the system. And that's something we all are interested in avoiding. Even if a company doesn't become insolvent, the ability to, and which is everyone's hope, right? The ability to be able to evaluate that data would be another data point for a regulator to be able to repair it, so that in the event something were to happen at some future date, the data would be available. Next slide, please. And so this is a framework for pre-liquidation planning that the NAIC and the NCIGF have been working on for about 6 years. And we are now both in the process of turning this into actionable items. Many of them already are. Key items would be the Model Holding Company Act amendments that strengthen the hand of receivers and regulators in an insolvency in order to be able to coordinate all the data that is out there. There are a couple of other things in there too that are very important. Some examination provisions in there on data. Again, the receivership handbook changes, which are already in place. We're very gratified that we've been able to engage the NAIC on a very a granular level to speak in depth about what this pre-liquidation framework might look, to be able to answer each other's questions, essentially feel each other's pain. I would just emphasize that the guarantee funds are not interested in regulating a company or deciding when a company would be insolvent. That is the very last thing we want to be involved in, very last thing our members, the members of our members, who are the insurance carriers in each state, want to be involved in. We simply are interested in that very, very narrow body of information that will help the claims paying process go as smoothly as it possibly can. It benefits policyholders. That is my final slide, other than my contact information.
Roger, thank you very much. Let's now welcome back to our microphones and cameras, Dr. Eastman and the Deputy Commissioner of Pennsylvania as well. We'll use the time that remains for Q&A. Reminder to folks, they may submit questions using the Q&A feature in the webcast interface. We will monitor incoming questions and will pose as many as time permits. To begin with, let me pose this question. Does the guarantee system in any way encourage insurers to take excessive risks? Do we see any moral hazard there? Appreciate your comments there. Thank you.
Well, we do not see that, to be honest with you. Currently, the law, moral hazard, that is, the law currently does not even permit somebody selling insurance to talk about the guarantee fund system. So, well, and just as a practical matter, what we've also observed over time, almost very consistently, is that a lot of people don't know it exists. And so I don't think that there is any grand strategy out there to be able to game the insurance marketplace so that claims end up in the guarantee funds. That's my opinion.
Thank you, Roger. Panelists, any color? Anyone care to jump in there?
I certainly agree with what Roger said. Absolutely.
Yeah, I for my 2 cents, I agree as well. And one thing to note, as Roger said at the beginning, this is quite a unique system relative to the way this is dealt with in other institutions or other settings where this would be appropriate. The closest one to to home, I think the touchstone for most people is the resolution process for failed or failing banks and the Federal Deposit Insurance Company, or the FDIC. And of course, one of the big differences there, if you've been inside a bank at any point in your life, you've seen the stickers and the advertisements there all over the place. Versus not only do companies not do that in insurance, like Roger said, you're not allowed to do that. So that's I think an important distinction in this setting. So that's the one thing I'll add there.
Let's thank you all. Shifting gears a bit, an attendee writes to ask, prior to the 1960s, how did state regulators handle insolvent P&C companies? Who would like to take that one for us?
Well, I nominate Roger, but I know we used to collect assets and try to pay them out. I mean, without the system, it was a lot more difficult. But go ahead, Roger.
Well, I actually would like to hear Dr. Eastman speak to it because he's done the historical research probably in a way I haven't done it. Do you mind?
Yeah, I mean, my understanding is before the guarantee fund system, the companies the policyholders would be put into the legal process of liquidating the company's assets, and if there were debt holders or other financial parties involved, they would all be I don't know if this is grotesque, picking at the corpse of the company as it existed, and that led to a lot of the uncertainty about, well, who, do we pay which parties get paid first? So instead, this has led to a sort of a different system where for non-insurers, they go through this bankruptcy procedure, and it's a big legal thing, and who's going to get paid what, and when are they going to get paid, and what percent of what you're owed is going to get paid. We've sort of ended up in a system where we totally removed the policyholders from that, and insurance regulators have said, no, we know there are other stakeholders involved, but the insurers or the policyholders are going to get paid first. And so the development has clarified that as being what regulators are most focused on, is making sure policyholders get what is owed to them versus just the chaos of having this go through a legal proceeding.
I knew you, if I could just elaborate on that, I knew you'd give a better answer so that I could say this part. The reason why the system was created was as a response from industry and regulators, because the federal government was threatening to create some kind of a federal system because of because of the basic what you're talking about, Dr. Eastman. And there were a number of substandard auto companies that failed. This got the attention of a couple of Congress people, and it was like, well, we're going to go do this. And then the industry and the NAIC put their heads together and came up with this system. And one more thing I want to say about why, and this is why we are unique. What Dr. Eastman described it's not apples to apples, but it's similar to the way resolution occurs in Europe, because there the focus is on financial stability. It has not always been on consumer protection, and it's mostly about making sure counterparties are made whole. In fact, the regulation is so stiff there that it's all based on having no insolvencies. That's the objective. And that's not a policy that works here in the United States. It hasn't so far. This is what makes our system unique. And it's a constant explanation that we are providing to international regulators.
Deputy Commissioner, anything to add?
I think it's great that we don't have to go through the wild west of picking at the corpse anymore. I think the system is one that does prioritize the policyholder, and that's what's most important.
Wonderful. Let's jump into some other questions. We have an attendee who asks, with surplus lines insurers taking on a larger share of both residential and property, shouldn't they be required to contribute to the guarantee funds? And is that in any way feasible? We'd welcome your reaction to that question.
Anyone? I could speak to it, but I don't want to. Okay, so yeah, surplus lines are not covered by the guarantee funds. And this is I see a Amy Bach's question, and this is a really insightful, forward-looking question, because you're seeing a lot more risk gravitate to the non-admitted markets. And I think that does, over time, set up some interesting public policy issues for how that would, how policyholders in those insured by surplus lines, how that will play out, what those protections will be. And that could take any number of forms. Obviously, there could be surplus lines guarantee associations. They could become members of the guarantee associations, but probably there would be an insistence on paying in. But you can see how complicated that would be since they haven't been members.
Thank you, Roger. Anyone else care to add any color there?
Good.
So along the lines of business not contemplated by guarantee funds, another attendee asks, are there other specific lines of P&C business that are generally excluded from the guarantee system?
Well, one that I've dealt with, and I know others can elaborate on other types, is surety. We had a surety company go in, and that wasn't covered by the guarantee funds. We have a reinsurance company in right now, that's not covered by the guarantee funds.
Yes, and there are other non-covered lines, maritime insurance. It's a lot of it is business related insurance, and it's the emphasis and preferences for the public policy preference. I want to make clear it's the public policy preference. Legislatures decided this is for the personal lines.
So shifting gears a bit, what is the most interesting or perhaps the strangest asset, Laura, will direct this to you, that you have seen or heard of being recovered from a liquidated company?
Well, I would have to say, and this predates me, but I think it's fascinating, an interest in a hydroelectric dam somewhere out west, which you wouldn't think an insurance company would own, that we would have to sell as an asset, but that's what happened. Another interesting and sort of weird one is a big company, I think I mentioned it before, in Center City, Philadelphia, had a telescope in one of the offices. And I'm pretty sure they weren't looking at the stars. I don't know what they were looking at in Philadelphia, but that telescope made its way to our commissioner's office. It doesn't work, but it looks pretty cool in there. So I would list that one as well.
Wow. Interesting stuff. Interesting stuff. Want to shift gears a bit and ask all of you on the panel, if you had to identify this, how would you identify the most important tools to use in collaboration between regulators and guarantee funds to ensure that benefits are provided to policyholders with no gaps? We welcome your perspectives there.
I would have to say communication and sharing of data as early as possible. And I know it's easy to think, oh, we should be able to do it immediately as soon as we hear a company's in trouble, but it's not always that easy. We do it as soon as we can on our end, but definitely staying in communication and sharing data and making sure everyone has access to the same data systems.
I just totally echo that. It is the most important thing. Liquidations are complex. I mean, you're talking about unwinding a commercial enterprise, and sometimes that commercial enterprise was in good shape up until the time it went insolvent. And so that kind of communication needs to take place. We're working on some tools through NCIGF to make it easier for regulators to enter into confidentiality agreements with the guarantee associations that emphasizes we don't want to know everything. We want to know a little bit, just enough to be able to do our jobs better. It's the communication that's the most important thing, and constantly refining our technical tools to be able to, and that's something internally that we have a huge emphasis on as we go into 2025 and 26, is to make sure that every tool we have that we have built and manage, is working as well as it can, so that when we ultimately have these host of agreements that I believe we will have, we will not let anybody down on our end.
Thank you. Dr. Eastman?
So I'm, of course, not as in the day-to-day of this, being an academic in my ivory tower. But I will say, in doing this and prepping for this talk, and a few months ago when we did the life and health version and speaking to the regulators on that panel, as well as folks who have worked in companies, the appreciation of information technology and data storage, I think is maybe undersold, because it's not like a super high powered topic. It's not like necessarily something interesting, and companies don't advertise, oh, look how good our internal data processing is, because that's something on the internal side. But if we think about insurance companies that are, they tend to be relatively older companies, and data is so important to the basic operations, that we're going to have companies that transition from a world where everything was paper to a digitized world. And different companies did that at different speeds with different levels of efficacy. Not to mention, companies will from time to time undertake mergers and then have to figure out, well, how are we going to take all the data of the company we just acquired and whatever their internal data processing system was, and figure out how to integrate it or not integrate, or just lop it on to our existing systems. And you can imagine, I think Laura gave really fantastic color to this, the many, many challenges it can face if you are the party that has to go in and sort of figure out what's going on in there, from people who maybe designed the system, who have long ago retired, and it was running on entropy, but then when it stops, someone has to figure it out. And so to that extent, understanding the data and being able to figure it out is important, because, as we've all been emphasizing, part of the key is doing this in a timely manner with minimal interruptions to the policyholders. So I think that that's something, at least I've gained a new, having never done it, that sure sounds like a challenge to me. So.
And Frank, I know we're at the top almost, but I just want to say one thing. This isn't a hard thing that I'm going to say here, but I mean, was taught this a long time ago, that in this world, what's really important is to have empathy for what everybody else does. So we're talking about guarantee associations, but the work of the receiver is way bigger than paying policyholder claims. They have to unwind the whole company and take care of all those things. I mean, I think Laura's given you a taste for that. But our understanding of that, I think, makes for a smoother process. And Laura and her folks, her colleagues' understanding of what the guarantee funds do, will also do the same.
Thank you. We are nearly out of time. I will pose a final question for you all. For regulators, for lawmakers interested in learning more about the guarantee system in the United States and in their individual states, more specifically, where would you direct them? What resources exist? Who would like to lead off there?
I'll lead off, but I would direct them to the NCIGF website, because that's where I go for a lot of that information.
Yes, and people can contact me directly if they'd like. I'd be happy to talk with anybody about it. Or go to the website.
Dr. Eastman, care to add anything there, or the base has been touched?
I know from personal experience, the Florida, I believe that FIGA is what the guarantee system is called. That's one I, just because I'm in Florida and teach a lot of Floridian students and like to keep up on the Florida market. They have a really excellent website with lots of information and data. Anecdotally, other states have gone to have similar information, though I can't speak to them quite. I won't endorse anyone except for Florida very strongly from personal experience, but I'm sure Pennsylvania has very good websites to pick one out as well.
Not to slight Pennsylvania Property and Casualty Insurance Guarantee Association in any way.
Duly noted. We are up against the top of the hour. It's been a fascinating conversation. on behalf of both the NAIC's Center for Insurance Policy and Research and all of us here at the Institute's Griffith Insurance Education Foundation. Panelists, I thank you very much. Dr. Evan Eastman of Florida State University, Mr. Roger Schmelzer, President and CEO of the National Conference of Insurance Guarantee Funds, and Deputy Insurance Commissioner Laura Slaymaker of the Pennsylvania Insurance Department. Great to have you with us today, and we appreciate the insights and the expertise that you've shared. I invite all attendees of today's session to take a moment to provide a bit of feedback to us by completing the very brief program survey that my colleague Erin Campbell spoke of at the opening of our session. Your input is important to both CIPR and to the Institute's Griffith Foundation. Today's program will be available for on-demand playback in the days ahead. It will be posted to our respective home pages. With that, on behalf of Erin Campbell and the team at the CIPR, NAIC's CIPR, and all of us here at Griffith, I'm Frank Tomasello. Thank you for joining us and have a pleasant afternoon.